Sharia compliant wealth management, we have to define it as it's a screening process where certain industries, first of all, are not included in the Sharia compliant investment universe. So what are these industries? The first one is financial institutions, which means banks, insurance companies, and anything related to financial institutions where we have interest or we have the effect of leverage. They are excluded from the Sharia compliant funds universe and investment universe. The second is normal industries like tobacco, gambling, and other industries which are not acceptable under Sharia principles are also excluded. So maybe we should ask ourselves the question, what is different about Sharia compliant investing versus the conventional investing where you can invest in financial institution stocks and tobacco stocks, etc., and you cannot invest in arms and ammunition, for example, in the Sharia compliant world. So what does the Sharia compliant world actually allow you to invest in? Well, the first one is obviously telecommunications, infrastructure companies, real estate companies, certain types of commodity companies, which are energy, for example, or precious metals. And I think that is what is very important. So, telecommunications, media, telecoms, all these industries are permissible. Today, the good thing about the Sharia compliant world is that major index providers like Dow Jones, like FTSE, and like S&P have actually created equity indices like the Dow Jones Islamic Market Index, which is roughly made up of about something like 2,200 global stocks, which have already been screened and considered to be acceptable by the Sharia board of Dow Jones Islamic Market Index. Then you have the FTSE Islamic Market Index. We have the S&P Islamic Market Index. And I think that these indices have now given a very clean bill of health to what kind of stocks are considered to be permissible. There are certain Sharia boards of certain financial institutions who take even more conservative stance, and they, from those indices, actually select what stocks are going to be acceptable to their financial institution and to themselves. And so it's a more restricted universe in certain cases. But on average, I think we have a very good amount and volume of stocks available. There are also certain equity industry indices being created which are Sharia compliant, like in Malaysia, which means a national equity index, which is Sharia compliant. There's one in Turkey, just to give you some small examples. And I think overall, these are very, very good examples to have. I think the conventional wealth management actually has a lot more flexibility on the one hand, but it's also got certain disadvantages. Let's talk about first the opportunities that conventional wealth management offers to the investors. The first one is that you've got a much broader array of asset classes in conventional wealth management. So what are they? You have fixed income, you have money markets, you have equities, you have real estate. And these are what we call long only, which means that the managers are buying these assets, holding them in order to realize a profit. Whereas you also have in the conventional wealth management world what we call alternative investments. And what are these? These are made up of private equity, venture capital. These are made up of hedge funds. They consist of real estate. That's the way alternative investments are defined in the United States, and also commodities. So the real way that the conventional wealth management world works, that the financial planner who is dealing with a high net worth individual or an affluent customer has a broader, shall we say, array of tools that at his disposal in order to construct a suitable solution to the end needs of the investor. And that, I think, is the important aspect. Now, what are the dangers in conventional wealth management? A number of these products, like hedge funds, for example, in some cases, they are using leverage and also they're using derivatives. That by itself may not be a bad thing because sometimes derivatives are used for hedging purposes. If that is the case, it is not a bad thing. If, on the other hand, derivatives are used for speculative purposes, then that can be a dangerous thing because we have seen what can happen when volatile market conditions return and in crisis situations, the markets are gyrating rather heavily and losses of 10 to 20% in a day are fairly normal. So I think in that sense, we have the pluses and the minuses, and we have to be careful about that. That, I think, is really in a nutshell what conventional wealth management has to offer and what are some of the risks that investors need to understand when they are taking on board conventional wealth management solutions.